in 3240.
Welcome back to Money Exchange. Technical patterns in currency markets can have a significant impact on momentum and direction. And there is one particular type of technical pattern that most institutional banking traders I've associated with over the years like to follow, and it's called wave analysis. Earlier today, I chatted with Tony Sycamore, Director of Foreign Exchange at Commonwealth Bank, to find out what the wave patterns are telling us leading into 2016. Tony, and welcome to Money Exchange, our special last program for the year.
Hi Andrew, thank you very much for having me on the show.
Tony, before we get to the charts, let's talk about the technical analysis that you specialise in at the Commonwealth Bank. A lot of traders talk about the fundamentals having a significant impact on financial markets, and some, of course, only look at the technical side of things. With your experience over the years, what is your view on, is it the technicals that are driving currencies, is it the fundamentals, is it a bit of a combination of both? What are your thoughts?
Yeah, absolutely. My view is that it's a combination of both fundamentals and technicals which have a large influence on markets. I've seen a lot of traders who are purely macro traders, but even your macro traders generally look at charts, whether it's just for entries, stop losses or profit targets, they do refer to the charts. So for your pure macro traders, there's definitely a tendency to lean on charts for those reasons that I've mentioned. And then we have the other side of the coin, we have purely technical driven traders, and a lot of systematic funds are high frequency traders, probably not so much, but there's a lot of systematic funds out there, and generally they're trying to go with the trend, buying higher highs, selling lower lows if it's in a downtrend, and they can impact the market as well. So for me, technicals are very important for both of those reasons, for both the systematic community and also for the macro community. There is a reliance on charts.
All right, well, talking about the charts, let's get to those right now. We've got three charts to go through on the program tonight. The Aussie dollar against the US dollar. Let's start with your monthly chart and then walk us into the daily chart.
Sure. Okay, so the monthly chart of the Aussie, we've seen a fairly steep decline the 2 or 3 years preceding 2015. Now, what we've seen more recently is a period of consolidation, and generally after large moves. If you recall, back in 2011, we were trading up around 110, 110.81. If you then sort of come in closer to where we are now at current times, we've seen a period of consolidation between 69 cents and 74 cents. So a fairly common theme after we see a big move, I mean, we had a move there in the order of 40 big figures, is to see a period of consolidation. Now, where I see us currently is in that period of consolidation, and at the current time, the Aussie's trading around 71.30, which bizarrely enough is right smack, almost bang in the middle of that 69 to 73.80 type range.
So looking ahead to next year, Tony, obviously we've got rates now rising in the US and rates potentially staying on hold in Australia for next year, maybe even a tick lower. What's your anticipation with the Aussie dollar? We saw a 14-cent move in 2015. Are we likely to see that be repeated next year?
I think there's generally a downward bias still to the Aussie. I think once this period of consolidation is complete, we will push down below 70 cents. I'm targeting around the 68 to 67 cent area. I think if you started the year and you told people that the unemployment rate in Australia would be sitting around that 5.8%, there would have been a lot of disbelievers out there. So on one hand, you've got this cross current where the domestic economy is performing a little bit better than probably most expected for the year, but still the commodity sector is still under pressure. So you've got this tug of war going on, and I think that will be decided by the move that the Fed recently started, the lift in US rates. I mean, we knew that was going to happen. It's the first rate rise since 2006. In the grand scheme of things, in isolation, it's not a huge thing. I mean, when we think about the markets over the last 5 or 10 years, you know, we've had QE1, QE2, QE3, and we've had central banks come out in 2008 2008, all cut rates in tandem, sometimes by up to 75 basis points. So by itself, a 25 basis point move in the Fed's fund rate isn't a huge thing, but we do know that this isn't just an isolated case. It is the start of a series of rate rises, and from what the Fed told us on Thursday morning, they're going to raise rates by another 100 basis points next year. Now, the market hasn't factored that in. For some reason, there's a disbelief out there, and I think once the market comes around to the view that the Fed will stay on target to do this, you'll start to see the US dollar gain traction. So I guess it's a case where the Aussie, the cross currents between the commodities, as I mentioned, and also the improving Australian economy is probably settled by the fact that US rates, as you mentioned, are going up, and Aussie rates, I think, are probably on hold, probably out until 2017.
All right, let's go across to a part of the world where we've seen interest rates fall this year, and of course that's in Europe with a big stimulus program as well from the ECB. Talk us through the two charts you've got there for us on the Euro USD on the weekly and the daily.
Yeah, the weekly chart there is very clear for me still. I think the Euro, we had a push up to 117 midway through this year. It actually coincided with the Northern Hemisphere summer when liquidity wasn't particularly good, and then we've started to see the Euro push down initially through 110.80 and started to get that 104.58 former lows in its sights. Obviously the ECB at the start of December came out, and I think there was a huge degree of expectations that they would once again outperform or exceed on their expectations, that there would be a huge increase in stimulus there. Instead, it was somewhat more subdued than was expected, and the Euro sort of pushed up back towards that 110.50 area. Now, in hindsight, I think probably in 2016, a lot of us will look back and think, well, that was a fantastic level to re-short the Euro. Anywhere above 110, in hindsight, probably a great trade for those looking to short the Euro. I think with the US raising rates, with the ECB still pumping liquidity into the system, we'll see the Euro test that 104.58 level and break it in 2016. Now, I think probably when we last chatted, Andrew, we were talking about the Euro heading below parity, probably down to around that 95-cent area. Probably not quite so bearish now, probably looking still for that parity level as a general target for you.
Okay, so two currencies to go lower so far, the Aussie USD, Euro USD. Let's move along now to a currency pair that's seen some really stellar gains in the last 12 months. The pound against, of course, the Canadian dollar, which has experienced weakness through interest rate cuts and low oil prices. What are your thoughts on the charts there looking towards next year on the weekly and daily charts?
Yeah, it's nice to actually talk about a currency pair which is going up, Andrew, so thank you for referencing that. It's one where I think, as you mentioned, the commodity story isn't finished. We're seeing crude oil trade below $35. There's a possibility that it trades down below $30 a barrel, and we've seen better data coming out of the UK, particularly this week. Even last night we saw a good UK retail sales number. So we like that on a fundamental basis, but also on a technical basis. If you look at the weekly chart, we're in a nice upward trend channel, and the break above 103.60 was a level which we referenced last time we chatted, and that level has broken. We've since been up to 210, and we've retraced back to around that 206 area. So it's possible that we've seen the move up to 210 was the first target we chatted about. It's possible that we've seen the bulk of the move, but I think with the way oil prices are trading, we can still see a push up towards 212, maybe 215 in the new year.
After the break, we'll find out what impact China is likely going to have on global currencies in 2016 and what we should watch out for. Annette Beecher from TD Securities up next.